and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for the next, let's call it 25 minutes. I don't know if anybody's making the lines on the over under on my estimates for the show, but I usually take the over. So with that, let's go in and look at a few trades that we did last week. Now, on Wednesday, we didn't have a show, and on Monday, I didn't know that was going to happen, but Tradier put together a huge event with the Chicago Board Option Exchange, or CBO is what the name is nowadays. And you can find that online on the Tradier YouTube channel, inside also the Tradier Hub. But it was a full day of great speakers that came out, talked about zero DTE options, we had a couple of fund managers that came in that talked about picking stocks. So a lot of great speakers, a lot of great content. So you should check it out. So I didn't get to look at the Uber trade, and we did a Uber announce this week, and the stock is down a little bit. We did an open wing butterfly. And we might have did an adjustment on Wednesday, but at this point in time, we got 1 week remaining to expiration. We still got a chip in a chair. We got a chance of this underlying making it to the middle strike, or at least getting a little bit profitable. We didn't pay much at all for the trade. It was $1.24 at the midpoint, so it wasn't of a great expense. So we just need the stock to actually bounce back a little bit. We needed, when we put the trade on, well, 10%, I guess. I don't know if it's a little bit. When we put the trade on, the stock was up here. This is, let's go to the Tradier Pro software. Just notice that. The stock was trading right around 99. It got beat up, came all the way down, but it finished up at the end of the day. A little bit of a down day. Now it's just doing chop right around the 90 level. And the thing that is most notable, though, is that the 20-day and the 50-day there was no stopping. It just went straight through. So now that's acting as resistance on the overhead, and we saw it come back up to the 20-day. This is actually called a death cross. When you have the 20-day cross over the 50-day, that usually means that momentum is starting to wane in the stock. And I don't think it's a strong it's a strong phrase for a technical analysis thing that isn't really that big of a deal. I do think it does matter when you see like something where it's a major moving average, where you see a 50-day crossing over a 200-day. I do think that it matters a little bit more and a little bit more weight on it, but it's worth noting. And so now we're going to struggle to get back. We have to get back to when the stock was at 97. It was at 97.55 when we did it, and our middle strike is 99, and we did the 99.104. No, our middle strike was 104. We need the stock to get back to 99. We needed to move 10% in 1 week in order to make this trade profitable at this point in time. And so, like, you still have that opportunity. You still have that ability to see if we can get it there. But when you're doing the earnings trades, there's really not an adjustment that you can do. You could maybe do it on the day of if you feel momentum going in a different direction, but I always kind of approach them as they're an all or none scenario. And when you're doing the trades, you're not going to get them all right, because obviously there's a big factor about the earnings. And we've actually done quite well with a lot of our open wing butterflies heading into earnings. But this one, it doesn't look like it's going to pan out. I guess I don't need to harp on it anymore. I can set it up. If we got time, I'll come back and I'll actually set it up and look at where it's at right now. I would assume with 1 week remaining, 10% out of the money, that we're probably trading for close to zero. But I didn't actually put the trade in and look at the strikes. Now, on Rivian, we also didn't do very well on Rivian. Rivian came out and didn't have a good quarter at all. The numbers were bad, but the forecasts or the sales, the deliveries were up, but the revenue, the net margins, the headwinds that are in the EV space um, were all apparent that were there, but the sales took over, I guess, the stock price, and the stock had a strong move to the upside. But we definitely have a wedge pattern going on. Like if you see this coming right across, we're kind of building our own little wedge here, and the stock is just primed to go somewhere. It's still really going nowhere. I mean, if you look at the range here, we're going from 12 up to, well, I guess we could call it 17, right? Going all the way back to here. So 12 to 17. So it's definitely trading within a range. It's getting to a point where it needs to break out or go do something is what it does. And this was a strong catalyst. So like I said, the numbers weren't great. So we had the huge bump up in that. Guess the marketplace wasn't expecting them to deliver more than they thought they would. Okay, I'm not an auto analyst, so that happened. But now we're seeing the weakness in the stock, and it's coming back down. So I do have an alternative trade for this, and it's a trade where I don't want the cheese anymore. Just let me out of the trap. Okay, so if I look down here, we bought the 14 strike put. Rivian's at 1468 at this point in time. And the weakness is showing just because the guts of the company uh are hurting, and they're struggling, but they did deliver more vehicles than they thought they would. So I should say, than the analysts thought they would. And so in this instance, it comes down, we're trading right here. So we got some time left. And usually if I buy options outright, I err to buying more. Time is cheap in my mind on individual options. And it's mainly because of the way time decay works, right? As the markets, as expiration approaches, exponentially you get more and more time decay. So if I'm buying options, especially to speculate on a stock like Rivian around earnings, first of all, it's usually a cheaper underlying, which this is. It's a $14 underlying. You're still paying vol premium. Go a little bit in the money, get a little bit more delta, go a little bit further out in time. And as opposed to buying, let's say, a 5 lot of these option contracts because they're cheap and you bought out of the money ones, you buy a 1 or 2 lot. You still put the same amount of capital in. You just get an option contract that has some oomph behind it. And I very rarely just look at $14 stocks and trade options on them. We obviously, with our butterflies, we like the $100, $200, $1,000 stocks. You get some premium. It's easier to craft a strategy. But in this instance, because we bought this option contract, we got a chance here. So here's what I would look to do in Rivian. When we put the trade on in Rivian, we paid $1.45 at the midpoint, and that trade was Monday, November 3rd that we put the trade on. And that $14 option right now is trading for $1 or for 61 cents. So the market went against us. The weakness is showing up, though. I mean, there's a chance that I still am bearish on Rivian, and I would be for the quarter. But with this said, we could get out right now and sell it for 60 cents. And that's not a horrible loss. You still got 90 cents left in it. You still got some premium, and it's because we bought the December 5th option contract. But if I wanted to stay in it, and I wanted to lower my cost right now. So right now we're down, let's call it six. We're down about 50. No. We're down 80 cents on it. We're down 80 cents on the trade. I don't know why that was so hard for me. But if we look at this, we could sell this 13 strike. Okay. Bring in an extra 30 cents. We're down 80 cents. Then we're down 50 cents on the trade. We could just close it out and say, I'm just done. The option contract that we bought actually protected us a little bit because we went a little bit in the money. It still had a little bit of value in it. We still got some time left. We could just say, well, I think I'm going to be bullish on Rivian. I do think it's going to go up. Or if you sell the 30 strike against it, you leg into a long call spread. So in this instance, remember, we had this option on. We paid $1.40 45 for it. And now we're going to sell this option contract. Oops, wrong one. Let's click sell. And we bring in 30 cents. Now that offsets our risk. We have let's go down to, let's do the 12.50. Yeah, I want to get an extra 50 cents. I'm going to get 5 cents more. Okay, so let's get rid of that. Let's do the 12.50. Okay, so now we're bringing in 20 cents. So we're down 80 cents. We could sell this, capture that 60 cents, or we could sell the 12.50, $12.50 option contract, bring in an extra 20 cents, which lowers our cost basis to $1.25. And then we can make 150 if we get back down to the 12.5 level, which the marketplace is saying there's a 15% chance that we could do that based off of the delta. You have 28 days for this to work, and the marketplace is weakening. So it's not a great trade in that you're not saying to yourself, well, I want to be extremely profitable on this underlying, right? I'm just saying, well, I want to make a little bit. And if I do this trade and we do get the stock, the downside momentum to continue, which has happened the last couple of days, we get down to the 12.5 level, we're going to be a little bit profitable on the trade. So the reason why I didn't want to do the 13 is because we wouldn't have been profitable. It was only 1 point wide, and we would have had a cost basis of $1.15. So by going to the 12.50, we are $1.50 we can make, and our cost basis will be 20 cents cheaper. It would be $1.25. So we could make the potential to make a quarter on the trade and just let the thing ride until December 5th, which is 28 days away. Or obviously, if it gets down to that level, you can just close it. So that's one way that I would approach it. This is if you go into individual options, this is one thing that you can do. You can also, if you go wide on your spreads, like say we started by buying the 14 and selling the 9, you can buy the 9 back and then sell something closer to at the money. If you like to do long spreads. Now, I usually like to do those around earnings, but this was a $14 stock. So with a $14 stock, a lot of times I'm just going to buy the option outright, even though implied balls are high. Mainly because the options are going to be cheaper. And it's just as simple as this. I mean, if you're thinking of options as what they truly were formatted to be, is insurance products. The more expensive the underlying, the more expensive the option. So like if you're buying a car and you're hunting for car insurance, it's going to be more expensive to buy car insurance on a Bentley than on a Ford Taurus, right? There's just a difference in cost. So insurance is the same way in the stock world. A $14 stock, options in general are going to be cheaper than a $100 stock. All right. What else? Oh, CVX. So that stock's kind of annoying me a little bit. Once again, a lot of noise right in the middle here. We had the market come down. It ran all the way down to the bottom half. We were going to think about making an adjustment on Wednesday, but then we didn't have a show Wednesday. And then the market has came all the way back and it's bounced back, and now it's at 155. We put the trade together on CVX. We put 3 short spreads on. And I think it's interesting that Chevron is up today with the market struggling. Talked about this in the AI space. The sectors that I think have the most potential, if you are thinking about, I don't want the volatility of the AI space. If you haven't been in the AI space, it's hard to get into it now. I do think you have to have exposure, but you have to be okay with the volatility. But the safe havens are the platforms that are going to provide the energy for the AI space. They're building out that infrastructure, and I think we're going to benefit. If there's anything in the world that this influx of cash is happening, is it's going to shore up our power grid a little bit, which needed it without a doubt. But you're getting, because of the demand for power, because of the AI generation, money is flowing into these type of companies, and the potential, it's not showing up yet, but the potential is large for almost everybody in the space. So I would just be positive on the sector. And a great example of that is that Chevron is up today based off, and the market is struggling and the market is down. We didn't get the downturn in October that I anticipated. I was definitely wrong about that. I really thought when on October, I think it was October 1st, when the government first shut down, that that was going to be the catalyst, but it just didn't happen. But every day that goes by, it's the odds of it affecting the markets are getting higher and higher. Okay. But things are going to happen mainly because of what's happening with the airlines. Corporate travel is a big issue right now. And there's going to be a lot more pressure that's going to come onto the government. So I don't expect it to last that much longer, especially if their traffic controllers stop going to work or keep calling in sick, I should say. That's what's happening. Okay, Chevron. We did Google too. So Chevron 157.5 put. So we're still right there. We got 1 week remaining. We're right in the middle of the strikes. We got a positive update. And if we close above the 50-day moving average, so we were right about here when we sold it on the 3rd, which would have been on this day. Market has came all the way down, bounced back, came all the way back up. We sold it for a net credit of 150, 157.50, 152.50. So let's go look at that trade. CVX. And the 14th, 7 days away. Right in the middle, exactly, almost. All right. Sold that. And bought this. So we are down 70 cents on the trade. Put it on for 150. Got 7 days remaining. Okay, I'm going to introduce this concept to you. Yeah, I don't think I mind this. Sell that. We're still here. If we go 5 points, yeah. No, I don't like it. I don't like it. I was thinking about rolling this into a butterfly, but I don't think it's going to work in that instance. Sell the expensive one. I mean, we could flip the script on it. All right, let's look at this. Let's look at, we'd be closing this position right here. So we are short that. We would buy this one. And then we would sell this for, that'd be 3.5 because we were on the 152. And then we sell this one. And in that instance, we are bringing in, no, I don't like the adjustment. The way I don't like the adjustment on this trade. So if anything, we'd roll the whole thing down. And we're at the 157.50s. We could roll all the way down, and that means that we're going to have to fixate a loss. And I don't like to always, you'd be paying a net debit in order to do this, to get out of the trade. I still think that Chevron, the market's still going to go up in it, but we only got 1 week until the expiration date. So you could either get out of the trade, but if you rolled it, you would be closing this trade that we had on for $2.20, and then just selling the 52.50. We'd sell that and then go down. Well, let's do we'd have to do this one and buy this and bring in 70 cents. Okay, so once again, I don't want the cheese anymore. Just let me out of the trap. We're going to adjust it. We're going to move down. We're going to think that the momentum is going to cover. And it's kind of interesting because it does work out. 77 cents. You got 1 week to do the trade. You still have the risk. You're adding you basically got this done for net even, right? You were down 70 cents on the trade. You're going to bring in a net credit of 70 cents. You need the stock to stay above 152.50. If the market comes down, you have exposure of $4.50. So is it worth it? Is it worth doing it to have that type of exposure? You can obviously close it out if the weakness does not if the weakness actually comes back into the marketplace and it hits 150 or something, you could get out of the trade. But this is an adjustment. So once again, we put a trade on CVX Chevron on the 3rd. Is that when we did that? October 31st. It was a Friday. It was Halloween. We sold that position. It was at 150. $1.50 net credit to the account. It is now trading for $2.20. We closed that. We lost 70 cents. Roll it, in my mind, I would just close it and then open up a new one, but you could do it all as one trade if you wanted. And we sell the 152.50s and buy the 148. We bring in 70 cents. Now we're net break even on the trade, and we need the market to stay above 152.50. The market is at 155.28. If we look at the chart, that's showing some strength in the marketplace. I think it would be pretty big if we close above the 50-day moving average, but a very strong candle in a down marketplace. Adjustments aren't great, but that is a decent adjustment to the trade. It's been a while since we've had to adjust trades. We've done pretty well with a lot of, especially our earnings plays. And then Amazon's looking really good. That Amazon trade knocked it out of the park. We did a butterfly on Amazon, an open wing, and the market went straight up, basically. Yeah, it's hard to discount Amazon. They got beaten up last quarter. I think in the AI space, it's a winner. I think that they're just doing a good job of managing the space. AWS is strong. They lost some momentum because they're worried about Microsoft taking chunks of the cloud space away from AWS, but they're still doing very well in that space. I still like AWS and Amazon. I still think that's a strong stock in that space to be buying. All right, I think that's about it. Next week we have earnings. Disney is announcing. I'm kind of curious about when they're going to announce on Thursday before the open. On Monday, we got a couple of energy companies that are going to be announcing, and they have a tendency to do that on Mondays. But there's nothing that interesting to look at. Circle's going to be announcing Wednesday before the open. That's in the Bitcoin space. Beyond Meat is going to announce Tuesday after the close. But I don't really have a trade that I want to put on heading into the weekend. Maybe next week we'll look at doing, since there's not as much in the earnings space to play around with, we'll think about doing a couple more zero DTE trades. We haven't done those in a while. And so we'll come back and look at some SPX and try to do a little bit more of a daily thing. I think we'll do that on Monday. We'll put together a 1 or 2 day trade in the SPX, trying to pick a direction. We'll see what happens over the weekend with the government shutdown and see where we're at. All right, that's it. Wow, the over 11:26 a.m. I said 25 minutes. That's pretty good for me. With that said, we'll see you on Monday. Have a great weekend, and 11 a.m. Eastern Time, Options Guide TV inside the Tradier Hub, hub.tradier.com. Hope to see you in the hub.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.